How is the firm level credit risk analyzed? What are the different factors that contribute to understanding of the risk at the firm or the individual borrower level? And how is the risk matrix developed by combining together the impact of various risk factors? There are 4 factors that broadly contribute to the firm level or individual level business risk. Number 1, industry risk. Number 2, business risk. Number 3, operational risk. And number 4, financial risk. An example of industry risk will include those risks that are faced by the entire industry. For example, the steel and cement companies are likely to suffer if the construction industry or infrastructure development industry suffers a slowdown. So it's an example of an industry risk, and all companies in that industry are likely to suffer. Business risk includes risks like lockouts or worker unionism, and these will impact that particular business. Operational risk include risks like fraud or negligence on the part of the employees, the IT system failure, the business continuity plan or the disaster recovery plan not working, or let's say floods or earthquakes. Financial risks include those risks which are because of the financial management of the company. For example, the company has very less liquidity, they have very high requirement of working capital, or they have credit losses. These are examples of a financial risk. Let's look at the layers in which we can organize these risks and understand how they impact. If you look at this diagram, I have represented the layers of firm level credit risk using 3 layers. There are external risk or systematic risk on the outer side. These risks are, for example, the economic risk like GDP growth or recession, the political factors, for example, instability in government, social factors, for example, the way the social fabric is working or the law or order situation of the entire country. Then these risks impact all the industries in that particular economy. Now, let's say any industry, automobile industry, cement industry, or even IT industry will be impacted by the social, economic or political environment of the country. So industry risks are impacted by the outer layer, which is basically the systematic risk. Now industry risks, I gave the example earlier, are like construction and infrastructure slowdown that will impact the steel and cement industry. Now industry risk in turn will impact all the firms or the businesses in that particular industry. That impact will be felt in the form of business risk, operational risk, as well as financial risk. For example, if there is a slowdown in the construction industry, then the payments to the workers will be delayed, in which case unions can cause problems for the employer. Likewise, there could be operational risk because the employees might resort to negligent practices because they are not being paid well, or they are not being given a proper process training, in which case customers can become dissatisfied. Other risks that can lead to is, for example, if you cannot invest in your IT systems, the IT systems can go down, which will again lead to business risk for your company. Now looking at all these firm specific risk factors, which are business risk, operational risk, as well as financial risk, we can develop something called a risk matrix. We can look at impact or severity of each of these risks and then put them in a matrix to understand whether this is the kind of a company that we want to lend to. Here in this risk matrix, I have financial risk on one side, and these are classified into low, medium and high. So there is a company with, let's say, low financial risk, medium financial risk and high financial risk. And on the other side, we have the business risk and operational risk, which are again classified into low, medium and high. So here we are developing a 3x3 matrix. So there are 9 cells and then there are 9 decision points involved in this particular framework. We can see if the financial risks are also low and business and operational risks are also low, then there is overall a very low credit risk. If the financial risks are medium and business and operational risks are low, again we can classify it as a low risk, though not a very low risk kind of a borrower. Likewise, if the financial risks are high but the business and operational risks are low, then we can classify the borrower as a medium to high credit risk borrower. The borrower which has both financial as well as business and operational risk at medium level can be classified as a medium risk borrower. And if the financial risk as well as business and operational risk are high, then we can classify the borrower as a very high risk borrower. Based on this classification, we can take the decision whether we want to lend to this particular borrower, how much we want to lend, do we want to insist on a collateral, and how we want to price our loan. All these decisions are driven by the classification of how risky the borrower is. For example, we may say that we will not lend to the very high credit risk borrowers at all, which are in the right bottom cell in this particular matrix. Likewise, we may also say that we will lend only in exceptional cases to the high credit risk borrowers, which are in the right as well as rightmost cell as well as in the medium cell, which are high credit risk borrowers. We may say only in the exceptional cases we will lend to them if we have, let's say, very good quality collateral. We will be happy to lend to, let's say, medium to high and medium credit risk borrowers as long as the price is right and we have good collateral. We are very happy to lend to low credit risk and very low credit risk borrowers because they are very ideal customers for us, but of course as long as we can get adequate return on the credit facility that we extend. So this is how this risk matrix, which is developed looking at these three types of risk involved in individual firm level, which are business risk, operational risk and financial risk. We can use this matrix to basically decide whether to lend, how much to lend, what kind of collateral to take, and how to price the particular credit facility. I hope with this you have understood how the firm credit risk is assessed and how a risk matrix is developed in order to manage your credit business. If you have liked this video, please do subscribe to my channel as well as share with your friends who will benefit from this. Thank you very much and cheers.